Figure we'll give everyone a couple minutes to jump on. We have a few people still filtering in, but I'd defer to you whenever you wanna kick it off, Gabe.
All right, just wanted to welcome everybody and appreciate Willery Wynn providing these sessions for us. Got a chance to look at the slides ahead of time. Think that's great information. So appreciate all of you that are joining us. And I know a lot of us interact with Willery Wynn pretty frequently on the credit union side, and it's been for a while. And then I'd say probably, gosh, was it maybe 3 years ago, got to work with you guys on a public bank and acquisition work, and the work was excellent. And so just I'd put out to the group because I know just internally when we just see it so much on the credit union side, it kind of gets to be one of those things where, well, they work with credit unions. Well, no, you work with banks as well, but the whole gamut. So want to just make sure everybody's aware of that. And that's really all I wanted to make sure people are aware of. So I'll disappear and appreciate you guys' time and effort putting this together.
Yeah, perfect. Thank you, Gabe. And first off, it's an honor and pleasure to be presenting today. And thank you again, Gabe, for the invite and the opportunity to speak to your team. This is presentation number 2 from our 4-part webinar. So if you missed the first webinar, it was specifically focused on mortgage banking. There is a recording of that, so you can go back and listen to that if you'd like. Today we'll be focusing on purchase accounting, and then our next 2 webinars will focus on CECL and then validations both for CECL and ALM. We mentioned it on our previous webinar, but wanted to again congratulate the team on the Baker Tilly Moss Adams merger. That'll be a really good segue into today's discussion, which obviously is going to surround mergers and acquisitions and really the valuation and purchase accounting. Again, wanted to thank all of you all for the referrals over the years. As a firm, we really rely on our strong relationships with our audit friends. So again, really appreciate the years of support. For those of you who don't know me, my name is Cole Schulte, and I am a director here at Willery Wynn. I primarily lead up our fair value business line, which would include really the valuation and accounting related to business combinations. And then I also help lead up our CECL and validation business lines as well. In our last presentation, Doug Wynn kind of introduced the company. So I'll keep this real brief, but did just want to mention for those of you who don't know Willery Wynn, we're a financial consulting firm that works with community financial institutions. We've been around 23 years. To date, we have over 650 clients in every state, focusing specifically on financial institutions. It's funny that Gabe, that you mentioned that you all know us more on the credit union side, but we actually have more banks than credit union clients. It's pretty 50-50, but slightly more banks. including 66 publicly traded banks and 42 of the top 100 credit unions. In terms of the business lines that we offer, we do asset liability management, CECL, including validations for both ALM and CECL, servicing, which is of course what we talked about in our last presentation, and then fair value, which is what we're going to talk about today. That really including, again, valuation and accounting related to business combinations, as well as just kind of various loan valuation work, deposit work, and goodwill impairment testing as well. So before getting into the presentation itself, I have a little bit of housekeeping. Just wanted to go over some important information regarding how you can earn 1.5 hours of continuing professional education or CPE credit for this program. To earn full credit, you need to attend at least 75 minutes of today's session. Additionally, we will be posting 6 polling questions throughout the webinar. You must answer at least 5 out of those 6 polling questions to earn full credit. Please note that we do not need you to answer the polling questions correctly. Simply answering them is sufficient. And at the end of the webinar, a survey will launch. While you aren't required to complete the survey to earn CPE credit, we truly value any feedback that you have. And then your CPE certificate will be sent to the email address you registered with us next week. I also wanted to note that the presentation will be recorded and will be sent over following the presentation. You can also send over questions at any time, and I will try to address those as I go through today's presentation. Okay, so now that we got through kind of the housekeeping stuff, we can get into the presentation itself. So again, today we are going to be focusing on really navigating merger and acquisition accounting. Doug had mentioned this at the beginning of the slide deck for our mortgage banking presentation, which was time tested. You know, that we'd probably done that presentation dozens of times at this point. This presentation is also time tested. I personally have presented on this countless times at this point. Just most recently presented at it's not the CUNA Finance Council anymore, it's the America's Credit Union Finance Council in May on the same topic, using a lot of the same slides here. So hopefully you find the information relevant and informative and hopefully interesting as well. So before getting into kind of the valuation and accounting itself, I did want to briefly talk about our fair value services, just to provide some context for today's discussion. You're going to see a lot of valuation metrics throughout today's presentation, and so I thought it was important to provide a little bit of context to show kind of the number of transactions that are actually going into that data. So dating back to 2009, which is when the business combination accounting rules first came out, we have advised on over 650 transactions, including all types of transactions. So we've done, credit union to credit union mergers, bank to bank acquisitions, credit unions buying banks, mutual to mutual bank mergers, branch acquisitions. We've done a little bit of everything. So again, the data will really reflect that. Additionally, we've done a majority of the credit union mergers where the target asset size was greater than 1 billion. So we've seen more and more of those, which we'll get into here shortly. But again, that data will be reflected. And then we also, in terms of the services that we provide, we offer both a preliminary and a final valuation of the institution that's being merged in or acquired. And I think that's important when we get into the kind of the implications arising from the purchase accounting. You'll see kind of some of the benefits of a preliminary valuation. And then again, both the preliminary and final valuation data is also going to be included within the slide deck. And then of course, qualitative and quantitative goodwill impairment testing, we do quite a bit of that work, and we'll talk through kind of what that looks like and really what our clients have to do in terms of their goodwill as well. So what is today's topic? Purchase accounting really requires that the merged in institution's balance sheet be recorded at fair value. Note that I said merged in, that could be acquired as well. Really the accounting, whether it's a bank acquisition or a credit union merger, it's relatively the same either way. And so the presentation isn't going to be focused on credit union mergers or bank acquisitions. Just think of everything as both, unless if I state otherwise, since there are a couple differences. But essentially, you're going to be valuing the assets acquired, liabilities assumed, and then the fair value of the equity, including the amount of goodwill. I had mentioned, again, preliminary and final valuation services that are typically performed in most mergers. Some of the reasons for doing a preliminary valuation, I put on here, it's to better understand the accounting, combined balance sheet risk, and regulatory capital implications. And again, we're going to talk through a lot of that and some of the benefits that our clients get out of doing those preliminary analyses to understand the implications that do arise from the valuation and the accounting. So in terms of the topics that we're going to go through today, we're first going to take a step back and talk a little bit about the M&A marketplace as a whole. So before getting into kind of the nitty gritty valuation and accounting stuff, I did want to walk through kind of what the trends and economics have looked like in this marketplace over the last 10 years and more recently the last 4 years. From there, we'll get into the meat of the presentation, which is going to focus on the accounting basics. And so that's going to include a walkthrough of not only the day one and ongoing accounting, but I also think it's important to walk through the valuation itself and some best practices that we see, not only from ourselves, but from other vendors as well. From there, we'll get into some of the implications that I've mentioned. And those are some of the areas that are most important to our clients and some of the discussions that we're really having every day with our clients. We'll talk about some of the updates from FASB, and really there's one key one that we'll walk through. And then if we have time at the end, we'll talk a little bit about credit unions buying banks and some of the differences that we see there and some of the trends as well. But before getting started on the trends in economics, we do have our first polling question, which I will launch now. So I'll give everyone about a minute to respond here. Give about 10 more seconds before I close the poll. Okay, so it looks like we have a little bit of a mix. We have a majority that are somewhat familiar, some very familiar, and some not familiar at all. So that's great. So today's session should be very informative. Okay, so again, starting with some of the trends in economics that we've seen here, I wanted to start before getting into the M&A environment specifically is just looking at kind of a heat map or a distribution map of where credit unions are found in today's marketplace. And so what this map is showing, again, is the number of credit unions in each state, with the darker states having a higher concentration in credit unions and the lighter states having a lower or smaller concentration in credit unions. Probably not surprising that you see a lot of California credit unions, a lot of credit unions in Texas, and then also out on the East Coast. So I don't think that that's surprising. In terms of the total number of credit unions, there's about 4,500 credit unions left. So there's been a decent amount of consolidation in the credit union space over the last 20 years at this point. And we'll talk through kind of what that looks like here in a few slides as well. I also have a chart showing the distribution of banks. So similar to the number of credit unions, there is just under 4,500 banks left in the industry. Again, you see, a lot of banks out in California, down in Texas, out east, but you do see a larger concentration as well here in the Midwest. So again, just kind of some context for where financial institutions currently are, in today's environment. If you look in totality, we're at about 9,000 financial institutions left. So while the number of institutions has significantly decreased over the last 10, 20 years, there's still a lot of institutions, there's still a lot of small institutions left that potentially might, continue to be acquired, merged in over the next 10 to 20 years. So still a decent amount of institutions left, as you can see from these maps. So this graph, I mentioned there has been consolidation, and so I think that this graph highlights that fairly well, where from 2012 through 2018, we saw a fairly strong level of consolidation in the credit union industry. You can see credit union mergers, particularly through 2016, were running roughly around 230 to 250 announced mergers per year. We did see that decrease. So that decrease, particularly in 2020, 2021, we saw a decrease in the number of announced mergers. That wasn't surprising. A lot of that was driven by COVID-19, where we saw many deals that potentially were maybe about to be announced. Executive teams had been working on the merger. A lot of them were paused for good reason. Institutions had other stuff to focus on outside of a merger. So we did see a pretty long pause during that period. And then I think that there was some pent up demand. So that's really reflected in 2022. You can see a fairly large jump in the number of deals that were announced, but that has come back down. We saw 146 deals announced in 2023, another 162 mergers announced in 2024. So I don't expect that we're going to get back to the pre-2016 levels. We were seeing, north of 200 mergers per year. Part of that is there's just less credit unions left. So you wouldn't expect to see that level of merger activity. But I would say that while we've seen a decline in the number of mergers overall, I'd say it's still stayed relatively strong relative to what we've seen on the bank side. So we'll get to that graph here in a few slides. And kind of discuss some of the reasons why those two graphs differ. But in general, they've slowed, yes, but we would expect to still see kind of a healthy number of mergers per year, potentially increasing here over the next few years. And while the number of mergers has decreased in the credit union industry, what's interesting is that the size of the mergers continues to increase. So what this graph is showing is the average asset size of really the acquired or merging in institution dating back to 2012. And you can see really over the last 6 years, a little bit of a dip in 2021, but over the last 6 years, we've seen a pronounced increase in really the size of mergers, ultimately peaking in 2024. You can see in 2024, the average credit union that's being merged in is 90 million in total assets. And part of the reason for this is that we've seen a significant increase in the number of merger of equals over the last few years. I'd say pre-2019, there was only a couple that had ever happened, and now we're seeing a handful each year, including some significant deals that have been announced even over the last couple months. So this is a trend that I don't expect to slow down. I think we're going to continue to see institutions of, moderate size, even if you're talking about institutions that are a couple $100 million coming together, all the way up to institutions that are maybe a couple billion coming together. I think we're going to continue to see that as institutions want to achieve those economies of scale relatively quickly in order to compete in today's market. So I had mentioned this previously. Again, credit union mergers have generally decreased, but here you see bank acquisitions following a similar pattern, but I think it's more pronounced. So again, the number of bank mergers was very strong from 2012 through 2019, roughly averaging 250 deals announced per year. You can see those deals really fell off a cliff in 2020 with only 112 announced transactions. Same rationale that I walked through previously. largely driven by COVID and really just a pause in deals. 2021, I would attribute that again to pent-up demand, where you had institutions that were pausing in 2020. They waited as long as they could, and then eventually they went through with the announcement, potentially the deal in 2021. But then we've seen a slowdown since. So 2020 through 2024 has been I'd say a challenging environment for bank-to-bank acquisitions. And again, much lower than the number of credit union mergers that we're seeing each year. And I think one important thing to understand would be the difference between a credit union merger and a bank acquisition, because I think that helps illustrate why there's a disconnect here. So with a credit union merger, there's no actual price being paid for the institution that's being merged in. It is truly a merger where you're really just bringing the institution over. They have to be fair valued, which we're going to talk through, but there's no actual price being paid. With a bank acquisition, there's an actual consideration being transferred. There's an actual purchase price being paid. And that's really driving the reduced, I would say, demand for acquisitions over the last couple of years. And I think that there's a few different reasons for that. But one of the biggest ones is the disconnect in pricing between buyers and sellers. And that's really driven by a couple of different factors. One of them is going to be the unrealized losses that sit out on most financial institutions' balance sheets. So specifically, if you're thinking about AFS securities, the unrealized loss that sits in AOCI or other comprehensive income, that is very hard for a buyer and a seller to negotiate what the appropriate price would be when GAAP equity is written down so much more significantly than Tier 1 capital based on that unrealized loss. So that's going to be one big factor. Another factor would be for banks that use stock as currency. We've seen dilution really in really the price to tangible book value in the publicly traded bank stock market over the last 5 years. It started to bounce back a little bit, but in general, we've seen dilution. And if you're using stock as currency, that's naturally going to decrease the pool of prospective buyers. They just don't have the liquidity to kind of go out and acquire an institution. I think the smaller pool of sellers is also relevant here. There's just less banks. So I don't expect these to ever get back into kind of the 250 a year range that we were seeing prior to 2020. We've seen some weakening economic conditions as well, with some lower profitability at certain institutions. So whether it's trying to navigate the rate environment over the last few years with low rates and now high rates, or potentially trying to deal with some asset quality issues as asset quality is normalized over the last few years, and there have been some persistent issues in certain segments and geographic areas related to commercial real estate. All of that is to say that some institutions have focused more on dealing with internal issues as opposed to kind of going out and maybe wading into the M&A market. And then the final thing I would mention would be the regulatory environment over the last few years, and specifically the previous administration. That administration had done a lot to kind of firm up some of the merger rules. So there were rules that came out from the FTC and the OCC, really trying to strengthen some of the merger rules, lengthened the process to get approved in most cases, and kind of did away with some of the expedited review. The new administration's largely done away with a lot of that, and that was actually recent, where now there's the expectation that some of the expedited reviews are going to come back for institutions of a certain size. You'll also probably see some lessened or shortened review times, and so all of that is probably going to lower some of the barriers to getting these deals done. And so for some of those reasons, a lot of people in the industry are optimistic that we'll start to see a bounce back in these deals here, over the next few years. So we talked about the number of deals decreasing. I think it's also important to note that the deal values being paid have also been lower over the last couple of years. And you can see, 1.25 as kind of the price to tangible book, excuse me, being the average for 2024. A lot of that's driven by the exact same reasons that I just walked through in terms of why there's been less deals, in terms of, suppressed price to tangible book value on publicly traded bank stock. That's going to lower the price for those banks, as well as unrealized losses, making it difficult to negotiate prices. I think also just the challenging environment has potentially lowered profitability for some banks. And so, a bank with lower profitability is probably going to sell for less than a bank with higher profitability. So all of those reasons have lowered some of the deal premiums that we've seen in the market as well. So all of that kind of paints I'd say a challenging environment for bank-to-bank acquisitions with less deals, lower premiums. And so what we've seen is that credit unions have kind of filled the gap that was left when a lot of bank-to-bank acquisitions stalled out, or there have been less deals over the last couple of years. Not only have we seen the number of credit union announced acquisitions of banks increase in recent years, but their percentage of total, if you take the total percentage of bank deals, credit unions as a buyer have significantly increased relative to bank acquirers. So obviously this has been kind of a hot topic in the news, and rightfully so, given that the quantity of these has significantly increased in recent years. We do believe that these can be relatively challenging deals from kind of a strategic, tax, legal, and regulatory standpoint. And I'll talk a little bit through that at the end when we get to the credit union bank deal section. We've also seen, obviously, some significant pushback on these deals. So specifically banking trade groups have pushed back pretty hard and have also used these deals as kind of a rationale for, in the fight over credit union tax exemption, which we've obviously seen play out here over the last couple months. We've also seen some states ban these entirely. I know most recently, I believe just a few days ago, Washington State came out and passed a law which doesn't ban them, but what it does is it imposes a tax on the credit union if they choose to acquire the bank. So effectively banning it, because the credit union is not going to want to pay that tax. So it's been interesting to watch this fight on really a state-by-state basis over the last 5 years. And then in terms of kind of what's coming out of Washington, D.C., so far from what we can tell, it looks like credit unions have largely dodged the tax exemption that some had been talking about removing in terms of a certain asset size threshold. But we'll continue to obviously monitor those developments since nothing's obviously been passed at this point through both legislators. So that was a little background in terms of what we've seen in the industry. Before getting into the accounting, I will launch our second poll question. I'll give everyone a minute to respond here. I'll give it about 10 more seconds here. Still waiting on a few votes. Okay, so it actually looks like, for the most part, most of you have not had a client. So again, will be a good educational presentation here. Okay, so moving into the accounting basics. So not only do I want to talk about the day one and ongoing accounting arising from a merger or an acquisition, but I also want to start by talking a little bit about some of the valuation approaches that we see as well. I think that's equally important in terms of understanding the valuation itself, but then also, of course, getting into the accounting. But before doing that, I did want to take a step back and first off talk a little bit about what Topic 805 is. So Topic 805, business combinations, this was issued in 2009. So prior to 2009, financial institutions accounted for mergers using the pooling of interest method. So what that meant is that instead of having to fair value everything through the acquisition or through the merger, you really could just bring over the institution at book value. So that was very simplistic. It didn't require a valuation firm to kind of help out with the valuation and the accounting. Probably wouldn't be presenting today on this topic if we were still under pooling of interest. Beginning in 2009, FASB required financial institution mergers and required financial institutions to record any merger or acquisition at fair value. So this would again include credit union mergers, bank-to-bank acquisitions, et cetera, et cetera. So the first step before getting into the valuation is actually assessing the application of the business combination accounting rules. So it's really determining whether a financial institution has acquired a business or has potentially consummated an asset purchase. So I have on here the definition of a business combination. A business combination is a transaction or other event in which an acquirer obtains control of one or more businesses. So there's some key differences in terms of how you account for a business combination compared to an asset acquisition. One of the key ones would be goodwill. So goodwill is recognized in a business combination, but it is not recognized in an asset acquisition. So that's one huge identifier right there. If you're going to recognize goodwill, it's a business combination. You don't do that in an asset acquisition. Another important differentiator would be acquisition costs. So acquisition costs are generally expensed as incurred by the buyer in a business combination, while the same costs are considered part of the acquisition costs in an asset acquisition. And then the final thing I would touch on here would be how you determine value between a business combination and an asset acquisition. Assets acquired and liabilities assumed in a business combination are measured at fair value, while assets acquired and liabilities assumed in an asset acquisition are measured by allocating the total cost of the net assets based on the fair values of the individual assets acquired and liabilities assumed. So today's presentation is going to focus on business combination accounting and measuring everything at fair value. But again, the first step is assessing whether you need to apply these rules in the first place. So most firms, valuation firms, are going to follow kind of the same similar steps when determining what you need to do through business combination accounting and ultimately to determine the fair value of an institution. The first step is typically to determine the fair value of the consideration transferred. That's going to be a little bit different when you're thinking about a credit union merger, and we'll talk through that in detail when we walk through that step. From there, you have to determine the fair value of the balance sheet. So that is going to include the acquired institution's financial assets and liabilities, as well as the institution's non-financial assets and liabilities. You then have to assess the fair value of any intangible assets, with the most common being the core deposit intangible and mortgage servicing rights. From there, you would assess the fair value of the trade name. And then the last step would be determination of fair value of the equity and the resulting goodwill, or in infrequent cases or rare cases, a bargain purchase gain. So I'm going to walk through all of these in greater detail here next. So I had mentioned there's a little bit of a differentiation in this first step between a credit union merger and a bank acquisition. So with a bank acquisition, it's relatively simplistic. The fair value of the consideration transferred, the purchase price, that's going to be what the institution's worth, because that's what someone's paying for it. So that's typically pretty simplistic. It's determined via some variety of approaches, which we're going to walk through here, but typically that's going to be done. It's either going to be negotiated between buyer and seller. It might be done by an investment banker, maybe a broker. But again, it's typically determined, and then that's the price that's being paid. With a credit union merger, it's different because again, there's no price being paid. And so a valuation firm like Willery Winn, when we're doing the valuation and purchase accounting, we would have to come up with a theoretical value for the institution in order to assess ultimately what the goodwill is for really the business combination accounting. And so whether it's a bank acquisition, it's being done by an investment banker, or whether it's a valuation firm with a credit union merger, assessing a theoretical value, you're typically going to see similar methods that are used. And so I highlight here 3 different methods that are typically used, and specifically 3 methods that Willery Winn uses when assessing either the fair value of the consideration being transferred or the fair value equity if it's a credit union to credit union merger. So typically kind of the gold standard, the main approach that would be used would be a discounted cash flow method. So this would be done by estimating future earnings by developing pro forma balance sheets and income statements. Really what you're trying to do is you're trying to get to a forward-looking future income stream, which can then be dividended back to the valuation date, or discounted back to the valuation date, excuse me. We discount dividendable income because we believe that a certain percentage of income needs to remain at the institution in order to maintain capital adequacy, but a certain amount would be dividendable. That's going to be the amount that we're going to discount back to our valuation date using an appropriate discount rate. We also recognize that a sizable amount of the value that's going to be driven out through a discounted cash flow method is going to be the terminal value calculation. So that's really a lifetime earnings estimate. That's going to be where a lot of the value is driven out through the discounted cash flow method. So we would typically apply the highest weighting to this method since we believe that it would be the most reflective, the most representative of really what the value of that financial institution would be, given that it reflects the actual projected ongoing earnings for that institution. But we do benchmark that method with 2 other methods. So one of them would be our guideline transaction method. I also see this commonly called the precedent transaction method really in the industry. So this method would be really trying to find a pool of banks that have been acquired in the industry of similar size, profitability, potential similar geographic area, maybe similar business operations, really trying to find banks that are similar to the institution that's being acquired, whether it's a bank or a credit union, and utilizing that pool to determine a median deal value to tangible book ratio. So in this case, you can see all the way to the right, the median deal value for these transactions was 1.36. You would apply that deal value to this institution's capital. You'd probably strip out some of the capital. We would call that excess capital being stripped out, since we don't think that premium should be applied to all of the capital. That's going to get you to the value derived through the guideline transaction method. So we would view this method to be a pretty strong method because it reflects actual deal values being paid in the industry. But again, it's a little bit more high level since you're not actually diving into future earnings for this institution. And then the final method we would use a little bit more as a benchmark would be our guideline public company method. So similar to the guideline transaction method, we'd be trying to find banks of similar size, profitability, business operations, asset quality. But in this case, we'd be looking at publicly traded banks. And what we would really be looking at is their price to tangible book value. We recognize that the price to tangible book value is a minority share. It's a minority value. And so we need to adjust that minority value by really control premiums that are paid in the marketplace in order to get to that majority control. That majority control value that we get to, that's going to again be multiplied by the financial institution's capital less any excess capital, again to get to a value through this method. So this method also serves as a nice benchmark, and the 3 methods that I just walked through really aggregate together to get to either your purchase price or potentially the fair value equity determined through the merger of a credit union. Okay, so now that we got through the first step, excuse me. So I had mentioned that I was going to include some metrics from work that we've done here at Willery Win. We don't necessarily do work in terms of determination of purchase price for banks, but what we do work on is the determination of fair value of equity in a credit union merger. And so this would show some of the results we've seen, really dating all the way back to 2009, where you've seen significant recovery in terms of the value of institutions that are being determined in terms of that fair value of equity. We have seen a little bit of a decline in recent years, and I don't think that that's surprising given that it really mirrors. If you remember the graph I showed earlier in terms of deal values being paid to banks in the industry, it's not surprising that our values in terms of theoretical values for financial institutions, specifically credit unions, is also showing some compression based on lower deal values, as well as some lower profitability that we've seen in the credit union industry. Okay, so now that we got through the first step, the next step would be determining the fair value of the net assets and liabilities that are being acquired, starting with the financial assets and liabilities. So I'm just going to walk through kind of the most common assets and liabilities that we see that are valued really through our valuations as part of the purchase accounting process. So starting with investments, so certificates of deposit, those are going to be discounted over the expected life of the asset using estimated market interest rates. Any type of other securities, MBS, CMO, municipal securities, those are typically going to be priced either using Bloomberg, which we have internally, or some other pricing service. So there's a lot of different vendors out there that obviously do the mark to market on securities. So that's going to be a major asset that has to be valued through the purchase accounting process. Some other assets would be accounts receivable and payable. Typically, those come over at book value. Prepaid expenses, those are valued by considering whether the prepaid item would have benefit to market participants. I can tell you that in most cases, that also does come over at book value. Accrued liabilities also typically comes over at book value, but it is important to note that, as we mentioned earlier, that the costs of the acquisition should be flowing through the income statement of the acquiring institution. We occasionally see the merging in institution accruing for those expenses, so just something to note there. And then additionally on the liability side, borrowings, those are going to have to be valued, discounted over the expected life of the liability using estimated market interest rates. And then for deposits, any time deposits similarly would be discounted over the expected life of the liability, also using estimated market interest rates. But non-maturing deposits, those are actually recorded at book value, but that's not to say that there's not value arising on those non-maturing deposits. There's actually going to be a premium that arises called the core deposit intangible, which we're going to walk through here in a few slides. Which brings us to the loan portfolio. So this is, it's a financial institution. Most of the time, the loan portfolio is going to be the largest asset class that's held. And not surprisingly, the loan portfolio is far and away the most complex piece, both for the valuation, but also in terms of the day one and ongoing accounting arising from these transactions. So just to kind of walk through a little bit in terms of what the valuation looks like, we would be discounting the contractual cash flows using really what we would call a best estimate of expected cash flows. So what we mean by that is we would be starting really at the loan level with the contractual cash flows per the loan agreement. We would then be modifying those cash flows based on estimates for prepayment, default, and loss severity. So prepayment being, voluntary prepayment, default being involuntary prepayment, and then loss severity being the loss given default. So that's going to be, those modifications are going to get us to our best estimate of expected cash flows, which we then discount back to the valuation date at an appropriate discount rate, which we net of the credit spread. So that's going to get us to really fair value. And that discount or premium on the loans, really that's going to adjust the book value of the loans on the financials. And so this is an example of what our loan valuation would look like. So again, it would be based on contractual data running through really at the detailed loan level for residential real estate and commercial, at the more category level based on loan type and credit quality characteristic for consumer. We'd be running these loans through a discounted cash flow analysis and then again modifying by CRR, CDR, and severity percentage. So CRR being the voluntary prepayment, CDR being the default rate, severity being the loss given default. So that's going to all get us to a future loss percentage. So that can be thought of really similar to a CECL mark in terms of lifetime credit losses expected on the loans. But then there's another component, which is again the discount rate component. So we would be using a build-up discount rate methodology, starting with best offered rates in the industry, adding discount spreads for loans with lower FICOs, higher LTVs, delinquencies. That's going to get us to an all-in discount rate, which we apply to the spread basically to the institution's current coupon. So here you can see an example off to the right. You can see the fair value difference comprises two different components. So there's going to be a loss component or a credit estimate, which again is a lifetime loss estimate. And then there's going to be a rate component, which is really the mark to market, again, comparing the interest rate on the loans at the loan level to the market discount rate assumptions. So this is really important to kind of visualize, I think, because the accounting gets fairly complex on day one and day two, which we're going to talk through here shortly. So it's important to understand that discount or premium would comprise two components, both a credit and a non-credit component. Another important thing to assess when you're doing the valuation of the loans is regarding if there's any loans with more than insignificant deterioration in credit quality since origination. So this is really the classification of PCD accounting, purchase credit deteriorated. We're going to talk a bunch about PCD accounting here in a few slides. And then the allowance for credit losses, that is going to be actually recorded at 0. Given that the loans are being marked and there's an estimated discount or premium that includes the estimated credit losses, the allowance for credit loss actually does not come over through the merger. So again, just a nice visualization of what a typical loan valuation might look like, including the overall discount, including the credit and the rate discount. Again, I had mentioned that there was going to be valuation results kind of sprinkled throughout this presentation. This shows all of the loan valuations we've completed for our merger clients dating back to 2009. You can see the significant recovery post 2012, where we had portfolios that had a lot of credit losses coming out of 2009, not surprisingly, but that largely recovered kind of post 2013, 2014. Remained relatively strong really through 2019. You can see that premiums, within our valuations for the loan portfolio really peaked in 2020 and 2021. This really being driven by the really low rate environment at that point in time. So if you think about when the Fed cut rates to essentially 0, you had loan portfolios that were having premiums being driven out on the rate discount, given that our market discount rate assumptions are largely going to be based on best offered rates, which significantly decreased based on the Fed cutting rates. So again, you kind of see a peak in our loan fair values in 2020 and 2021. You can see all of that's really flipped over the last few years. So you can see a significant decrease in loan fair values post 2022. That's when the Fed started increasing rates and then obviously maintained high rates through 2024 and 2025. We've seen continued devaluation across most portfolios over the last couple of years. We've started to see some of that devaluation come back as loan portfolios have started to reprice with the market over the last few years. But I think that it's important to note that the significant decrease you can see here in fair values that we've seen across most clients is largely not credit driven. It's largely rate driven. So most of it's just driven by the rate environment, not as much by the credit environment, although we have started to see some increases in losses, really, especially on the credit union side over the last year, really across a lot of our valuations. So now that we've walked through the financial assets and liabilities that needed to be valued, the next step would be determining value for any non-financial assets and liabilities. So typically the most material asset that would be valued through the, on the balance sheet, aside from the loans and the investments, would be the land and building. So this would be branch locations, headquarters, whatever the financial institution might hold. Typically, this is one area that's outside of most, I would say, valuation firms' expertise, would be going out and hiring a commercial real estate appraiser to determine, the fair value of those assets. Occasionally, we see something more abbreviated used, especially for preliminary valuations. Oftentimes, maybe it's a broker opinion of value or a BPO, broker price opinion. Maybe it's a tax assessed value for preliminary valuation. Sometimes something more abbreviated is also used for the final valuation done as of legal day one. But in most cases, we do see commercial real estate appraisals be used, given that they do generally, do reflect the best indication of value for what the land and building is worth. Any other fixed assets also, need to be valued. Typically, they're brought over at book value. Occasionally, we'll see, maybe some fixed assets discarded, written off through the purchase accounting process, especially in cases where it's kind of deemed immaterial. And then the final piece would be any real estate leases. So those technically should be assessed to determine if a lease asset or a lease liability exists. So typically this is also performed typically by a commercial real estate expert who would go out and really determine market rent rates in the specific geographic area to where the lease really exists. If it's an owner-occupied lease, if the lease cost is less than market, then an asset would be recorded. If the lease cost is greater than market, then a liability would be recorded. On the flip side, if we're talking about a tenant lease, then it would be the exact opposite of what I just stated. If you're receiving more than market, it would be an asset. If you're receiving less than market, then it would be a liability. We always encourage our clients to collaborate with our audit friends to basically deem if this step is necessary. Sometimes it can be pretty immaterial, depending on the number of leases or the amount of time remaining on the leases, but should be something that should be assessed through the purchase accounting process. Again, looking at valuation data, so looking at fair value of assets and liabilities throughout time, you can see that the fair value of liabilities has remained pretty consistent, typically comes in pretty close to book value for most institutions. But the fair value of assets, not surprisingly, has been pretty volatile over the last 16 years. You can see that it really mimics the fair value of the loans that we just looked at a few slides ago. With, again, recovery post 2012, 2013, we saw premiums peak in 2020 and 2021, and then have really fallen off a cliff over the last couple of years. That, again, is going to be driven by the discounts really on loan portfolios, as well as discounts on investments that we've seen over the last couple of years. Okay, so now that we've talked about the fair value of the financial assets and non-financial assets and liabilities, the next step would be assessing the fair value of any intangible assets. So the most notable intangible asset that arises through a business combination would be the core deposit intangible. So the core deposit intangible is the premise is that a rational buyer would be willing to pay a premium to obtain a group of core deposit accounts that are less expensive than the buyer's marginal cost of funds. So said a slightly different way, it's really comparing the cost to hold the deposits that are being assumed through the merger or acquisition to the cost to go out and borrow in the marketplace. And if it's cheaper to hold the deposits than it would be to borrow in the marketplace, then this intangible asset arises called the core deposit intangible. So we typically would be estimating this using a discounted cash flow analysis where we would really be comparing the cost to hold the deposits. And when we're looking at the cost to hold the deposits, typically we're looking at kind of both the interest rate component. So, what are the deposits actually paying in terms of interest or dividend expense? And then the secondary piece would be the non-interest expense component. So we do layer in an operating cost or an overhead component to holding those deposits or shares. And then it's really comparing to the cost to borrow in the marketplace. And so this is always my favorite chart to show in this presentation because it's so volatile. It really is all over the board, showing the core deposit intangible premiums that we've seen, again, over the last 16 years at this point. You can see that core deposit intangibles essentially went pretty close to zero during the COVID environment. So we were consistently seeing core deposit intangibles of less than 1%, less than 50 basis points during COVID, given that the Fed funds rate was so low, it was so cheap to borrow, there really wasn't any benefit, at least from a cost perspective, of going out and having deposits relative to borrowing. It was just too cheap to borrow. That's all flipped now as the Fed started increasing rates in 2022. We're now seeing core deposit intangibles in kind of the 4 to 5, even north of 5% range in some instances. And they've really sustained and remained at that level over the last couple of years. And that's not surprising either. When you see borrowing costs in kind of the 4.5% range, and they got close to the 5% range during some periods, compare that to the cost to hold deposits, you're going to have a large spread, which has really driven out the core deposit intangible premium. We haven't necessarily seen the run up in terms of deposit rates across most of our clients. We saw a lot of CD rates increase with a lot of CD specials and really pricing those up, but we don't include certificates of deposit in our core deposit intangible. This would be the non-maturing deposits or shares. And when you're thinking about demand deposits, now accounts, savings, share drafts, regular shares, a lot of those are still, especially with some of the institutions being merged in, those rates are still very low. And so we didn't see those rates come up during this cycle. And so that increased spread has significantly increased some of the premiums that we've seen over the last couple of years. Aside from the core deposit intangible, you should also be assessing, customer relationships. Typically, the value of those is embedded in the purchase price. Trade name could have a value based on how widely it's recognized. Honestly, in kind of like the community bank and credit union space, we don't see a lot of trade name value. Maybe if with a credit union, if like the sponsor was a very well-known name, you could potentially see something there. And then mortgage servicing rights. Not going to spend much time here because we just had a whole presentation on it, but it's the rights to service a loan that has been sold in the secondary market for a fee, and it's typically determined via discounted cash flow analysis. Okay, so then the final step would be the determination of the amount of goodwill, or in rare cases, a bargain purchase gain. So goodwill, put simply, is the amount required to balance the day one journal entries. So when we're thinking about the fair value of equity or the consideration being transferred for a bank acquisition, goodwill is going to be the difference between the fair value of equity that was determined via the discounted cash flow and market approaches or the purchase price. It's the difference between that and the fair value of the net assets or the fair value of net assets or liabilities that are being acquired. So that's really going to be the determination of goodwill. And mergers generally result in goodwill, because what goodwill results when really the purchase price or the fair value of equity is higher than the fair value of the net assets being acquired. You don't often see, especially if it's like a bank acquisition and there's actually a price, you don't typically see someone buying something for less than the fair value of what it's worth on the balance sheet. And so a bargain purchase would be that instance in which it's the price or the fair value of equity is less than the fair value of net assets. I can tell you that FASB actually tells you to double check your work if you do have a bargain purchase. So they're relatively rare. They can happen, but relatively infrequent. And we'll talk a little bit about the implications of goodwill. But goodwill, it is deducted from Tier 1 capital for banks, and it is also deducted from risk-based capital for credit unions. Okay, so you got through the valuation, you have all these marks. This is a very clear example of really what the day one accounting would look like. In this case, this would be a credit union merger example. So just really quickly, if I just kind of walk through this, you'll see that if I start at the top with the investments, really for AFS securities, the accounting works as if they're being acquired or purchased in the marketplace. So any existing premiums or discounts, the existing unrealized loss, those are actually going to be written off or debited and credited out. And then the new discount, which in this case would be the 7.7 million credit, that's going to be the new discount on the securities really on an ongoing basis. So you're going to have a security that's written down to a new discount or written up to a new premium. That's going to be amortized or accreted on a level yield basis over the life of the security. And then they're going to be reset to market on a monthly basis going forward by whoever's doing that ongoing accounting. Similarly, on the loan side, I had mentioned that kind of the loss component and the rate component, there's a differentiation there. There's also a differentiation for PCD assets. We're going to talk through that here shortly. But the important thing to note here is that these are contra accounts that are going to net against the book value of those acquired loans. And then the discount, the rate component is going to get accreted back into income. The way the rules currently stand, the credit adjustment would also get accreted back into income. And then you can see the allowance for loan loss of the 3.6 million there. That would actually be a debit that would be removed given that the allowance for credit loss is not brought over through the merger. You can see some various other adjustments. You'd have the write up or write down to land and building. In this case, there was a write down. The core deposit intangible, that's going to be a new asset. It's a debit that has to be set up with the combined institution financials. We'll talk about what that looks like in terms of the ongoing accounting here shortly. And then some miscellaneous contra accounts that have to be set up for the liabilities. And then at the bottom, you have your equity. So the book value of equity is booked as a debit. So it's really just removing the book value of equity that existed at the point in time of the merger. You have your fair value of equity or your equity acquired in merger. That's going to be the equity that was determined via kind of the three different methods that we walked through previously. So that's going to be booked with a credit. And then, as I stated previously, goodwill is the amount that balances these entries. It's a little confusing that we have it in equity. It's not an equity, it is an asset. We have it at the bottom to kind of reconcile, to tie everything out. But goodwill, again, would be the amount that would really balance all of these day one entries. We also show an example for a bank. I'm not going to walk through this in detail because everything basically is the same. The only difference is that there's an actual purchase price being paid. And so you can see at the top, the purchase price, that would be the paid in capital that would be booked for the combined institution. The book value of equity would again be a debit to remove that amount. And then again, goodwill would be the balancing entry in both instances. Okay, so we talked through the day one accounting. You saw an example of what the day one accounting looks like. You then have all of these day one adjustments, and now the question is, okay, what do we do with them on a go-forward basis? And so this gets us to what we call the day two and ongoing accounting. We talked about the investments a little bit already with the premium or discounts being amortized or accreted as a decrease or increase in interest income. I always say with purchase accounting, if it's good news on day one, then that means that it's probably bad news into the future. So a premium on an asset is going to be, a decrease in interest income going forward. A discount on an asset is going to be an increase in interest income going forward. It's the exact opposite on the liability side. So a premium on a liability will be a decrease in interest expense, whereas a discount on a liability will result in an increase in interest expense on an ongoing basis. The core deposit intangible, that's going to be amortized on a level yield basis over the estimated lives of the non-time deposits as a reduction in non-interest income. Said another way, it's really an expense on an ongoing basis. And then fixed assets, the new value, it's going to have to be depreciated over the estimated remaining lives, which oftentimes is reset after the acquisition. Okay, so then that brings us back to the loans, which again, I stated earlier, this is the most complex piece, and I briefly alluded to PCD versus non-PCD accounting. I'm going to walk through this in detail, but I'm going to preface it by saying that FASB is currently doing work to undo all of this. So while I'm going to walk through how it currently works, it is important to note that there's currently some pending guidance that I'm going to get to here shortly that will undo much of what I'm just going to walk through. So I talked about earlier PCD, so it's the determination of financial assets that have experienced a more than insignificant deterioration in credit quality since origination, as determined by an acquirer's assessment. It's important to note that as determined by an acquirer's assessment, that makes it relatively vague in nature. And so we at Willery Wind, we don't have like a line in the sand for what is PCD and what is not PCD. We work with our clients to help determine what should be scoped in. But again, it's a little bit more vague than the legacy PCI accounting, purchase credit impaired, if you remember that, 31030 accounting. This is a little bit more vague and broad in terms of what can be scoped in. And then non-PCD loans, these would be loans where the acquiring institution expects to receive all contractually specified P&I. So for non-PCD loans, I guess for PCD or non-PCD loans, either way, we as a valuation firm, we're going to determine fair value. There's going to be a purchase discount or premium on the loans that's going to have both a rate and a credit component. So I mentioned earlier, it was important to understand the difference there between the rate and the credit component. For non-PCD loans, that total premium or discount would be amortized or accreted as a decrease or increase in interest income. So you did not need to bifurcate between the credit and the rate discount. However, an allowance for credit loss would have to be recorded through provision expense on day one. So what this implied is that there was this double count on day one, where you had the credit loss related to the valuation embedded in the discount, and then you also have to reserve on day one the provision expense. And so while the accretion of the credit reserve would offset the provision expense over the life of the loans, there was this huge disconnect in timing, which resulted in a day one double count to capital, and it resulted in material, I would say, noise to our financial institutions' financials in month one and year one, as they had this huge provision expense. You compare that to PCD accounting. PCD accounting is much more friendly. So basically how this works is that the allowance for credit loss would be recorded through an adjustment to the amortized cost basis of the financial asset. And this is called the balance sheet gross up. And so what that essentially means is that instead of accreting the credit related portion of the discount, it states that we should just bring that over as the allowance for credit loss on day one. You would no longer accrete that portion, but you also wouldn't have to provision on day one for those loans. And then on an ongoing basis, any favorable or unfavorable changes in expected credit-related cash flows will run through the allowance and credit loss expense. So what that meant is, let's say that we all determine that for the PCD loans that the losses are $100,000 on the loan portfolio. You bring that over to the reserve, you don't have to provision, and then on day two, the client determines, hey, this should be $98,000. They could actually release $2,000 at that point, and they completely avoided the significant provision expense on day one. And then the non-credit premium or discount, that's going to be amortized or accreted as a decrease or increase in interest income based on the effective yield after the gross up. So I'm going to have an example that illustrates this here in a couple slides, I think in a little bit better detail. But before doing that, I do want to do our next polling question. So I'll give everyone a minute to answer this question. So it looks like we have a lot more of you probably work with banks based on the response here and the response earlier, where there wasn't as many who had seen the credit union merger, but more have seen the bank acquisition. But I'll give 10 more seconds to answer this question. Okay, I'm going to close out the poll. So 75% of you have seen a bank acquisition, which again was much higher than the amount who had seen the credit union merger. Okay, so from here I want to get into the accounting implications briefly. This is what's of most important to our clients. So when we're doing a preliminary valuation, these are the key things we focus on and say, hey, like we need to understand not only how to do the accounting, but how does the accounting actually impact our financial institution. And so we'll revisit kind of the PCD CECL discussion with an example. We'll talk a little bit about capital, goodwill, and then ongoing earnings. So I mentioned earlier I'd have an illustration here of non-PCD versus PCD. What you'll see here is a loan portfolio of 15 million with a discount of 500,000 in both examples. The one on the left shows the non-PCD framework. The one on the right shows the PCD framework. Either way, that 500,000 discount would include a rate discount of 400,000 and a credit adjustment of 100,000. If you look at the left, you know, that 500,000, including the $100,000 credit adjustment, that total amount would get accreted back into interest income. However, CECL would tell us that we need to reserve for these loans on day one. And so under non-PCD accounting, you would have to reserve. I put 100,000. It could differ from the $100,000 credit adjustment if you have a different vendor, you know, who's doing CECL versus who's doing the credit. But to make the math simple, I made them the same number. But in general, you would have this double count on day one, where you'd have the 100,000 that was embedded in the discount, but you also have to provision 100,000 on day one. And so there's this double count and there's this noise in provision expense on day one using the non-PCD framework. If you look at the PCD framework, in this case, the 100,000 related to the credit, that would no longer get accreted back into income. Instead, you would actually add that back to the amortized cost basis of the loan. The offset would go to the allowance for credit loss. You would avoid the double count. You would no longer accrete the 100,000, but you also would have to provision for 100,000 on day one. And so what you can see is that the net balance, including the allowance for credit loss, is 100,000 higher than the non-PCD framework, given that you're avoiding the double count. So again, we would view the PCD framework as much friendlier treatment than the non-PCD framework, and we'll kind of get through what FASB is doing about this here in a few slides. The next item we always talk about our clients with would be the impact of capital. So that's going to be one of their most important questions. It's also what the regulators maybe care about the most. Would be, hey, what does combined institution capital look like? If we start thinking about a credit union merger, again, with a credit union merger, you get to bring the credit union over without paying for the credit union ultimately, right? And so you get the equity, but there are two different equity calculations to consider. The first would be GAAP equity. So that would be the equity acquired in merger that would be determined via the valuation firm. So we talked about kind of the discounted cash flow and market approaches. That determines the basis for fair value of equity. That would be what the institution would have to count for purposes of GAAP equity. But for regulatory net worth, credit unions actually don't count the fair value of equity acquired in merger. They would actually use the adjustments to retained earnings through business combinations. So what that means is that they actually get to count the book value of retained earnings at the point in time of the merger. And so the benefit they get there is that any institution that has like AOCI or large unrealized loss on securities, that doesn't negatively impact the credit union's regulatory capital on a go-forward basis. So with a credit union merger, the impact of capital, it could be positive or negative. It could be dilutive or accretive. If the institution they're merging in has a higher level of regulatory capital than the continuing organization, they can actually see their capital be accretive really on a go-forward basis. So that differs from a bank acquisition, whether it's a credit union buying a bank or a bank buying a bank, where it's always going to be dilutive to capital, given that you're paying for the equity that's being acquired. So kind of a big difference there in terms of a credit union to credit union merger versus a bank acquisition. I also mentioned risk-based capital. That's important to discuss really for both credit unions and banks. It's important to understand the impact of intangible assets, which we're going to talk through here in a couple of slides as well. So I just mentioned the impact of intangible assets. So goodwill is going to be the most important one to think about here. I oftentimes get the question from clients where they say, hey, we have this goodwill that's arising from this acquisition or this merger. And the question is does that matter? And the answer could be yes or no, kind of depending, first off, if you're a bank or a credit union, and then also based on the level of goodwill that you're actually bringing on. So first off, it's important to understand how goodwill is treated. So for privately held banks and credit unions, goodwill can be accounted for in one of two ways. So it can either be amortized, which is typically done over a period not exceeding 10 years, or it can be annually assessed for goodwill impairment. What I can tell you is that amortization of goodwill is an irrevocable accounting election. And so we have some clients where let's say they bring on like 500,000 in goodwill, that they're averse to having the non-earning asset on their books. They want to get it off, so they want to amortize that. I caution them and say, okay, but if you do another merger or another acquisition and you bring on 5 million in goodwill, you would then be forced to amortize that as well. And so based on that, we don't see very many of our clients amortize goodwill. I would say 95% of our clients are doing impairment testing, which can be either done in a qualitative or a quantitative method. The qualitative is much more high level. It would be assessing in a qualitative manner the financial performance of the institution over a period of time. Typically, the reporting unit for goodwill testing as well, I kind of forgot to mention this, would be the combined institution, unless if the entity being acquired is kind of its own entity. Where we'd see that most would be with a bank acquisition, where if like the holding company acquired a bank, it didn't collapse the two banks together. We could potentially see then goodwill impairment testing being done at the level of the unit that was acquired. But in most cases, especially with credit unions, it would be done at the combined institution level. And again, it would be assessing really the institution's performance, profitability, asset quality, capital growth. We'd also look at macroeconomic trends like unemployment, housing price appreciation, depreciation. We would look at industry-specific variables, so net charge-offs, profitability for financial institutions specifically. If you're not able to qualitatively assess and say that it's more likely than not that the goodwill is not impaired, then you would move to the quantitative test, where you would be quantifying that the goodwill is either impaired or not. Typically, what you're doing here is you're using quantitative methods where you're assessing the value of the institution. Typically, you're using some method of approaches. We'd be using a discount cash flow method, as well as those market methods that we talked about way back at the beginning of this presentation, in order to quantify that the goodwill is not impaired. It's also important to note that publicly traded banks, they have to use the impairment assessment method. And then we talked about earlier the capital impact with goodwill being deducted from Tier 1 capital for banks and from risk-based capital for credit unions. Okay, and then the final implication that we like to talk about with our clients would be the impact to income. So we talked about earlier the amortization or accretion of these adjustments, with discounts on assets going to income, premiums going as a reduction to income, discounts on liabilities as an additional expense, and premiums on liabilities as a reduction to expense. It's really important for our clients to understand what these amounts look like, because sometimes there could be millions of dollars running through the combined institution's income statement thereafter. And so one of the benefits of the preliminary valuation we do is that we give them a really good budget of what this looks like on a monthly, ultimately an annual basis. Obviously, it's an estimate based on preliminary estimates, but one item that our clients really like to understand is really the impact of the bottom line based on the accretion estimates done via the purchase accounting. So I did include a brief example here of really what the purchase accounting can look like. I included this because we oftentimes get the question of, hey, are you seeing higher levels of goodwill, lower levels of goodwill, more accretion, less accretion? And my answer is always that it really depends on the balance sheet that's being acquired. So this is two institutions that look fairly similar to one another in terms of size, but have fairly different balance sheets. So the institution on the left would be more of a mortgage shop, with a higher loan to deposit ratio and a concentration in fixed rate real estate lending. The institution on the right with a lower loan to deposit ratio and a larger concentration in kind of shorter term lending. You'll see the impact here. Kind of ignore the CECL impact because we're going to talk through why that doesn't matter as much here shortly with FASB's updates. But you'll see the institution on the left with more goodwill but more accretion. That's because there's probably a larger discount on that loan portfolio, and that discount is outpacing the core deposit intangible premium to a larger extent. And so you're probably going to end up with more goodwill, all else being equal, but you're probably also going to have more earnings accretion. The institution on the right, maybe lower levels of goodwill, because you might have a smaller discount on the earning assets with the core deposit intangible offsetting those earning assets, but the ongoing earnings might be negative because, again, that core deposit intangible amortization might actually outpace the discount on the earning assets. So this is a really simplistic example, but just highlighting how it's really hard to high level say the impact without really looking at the institution specifics in terms of their balance sheet concentration or really what they're doing in terms of strategy, in terms of lending, investments, whatever it might be. So that brings us to our next polling question. So I will launch that here. So this question isn't that fair, I would say, because I'd say it depends on the size of the institution. If it's a smaller transaction, they might not need a preliminary valuation. If it's a very material merger or acquisition, then that's where we really strongly recommend our clients get a preliminary valuation. But again, can really depend on really the size of the institution. So I'll give about 10 more seconds to answer this polling question. Okay, so it looks like we have about 50-50 on very likely versus somewhat likely and only one unlikely. Okay, so then that brings us to updates, and I really just have one update from FASB, which all of you have probably heard about at this point, but it relates back to the PCD versus non-PCD framework that I just walked through. Originally, FASB was going to eliminate the distinction between PCD and non-PCD assets. They've actually decided to retain the current accounting for PCD assets, but they've revised the objective of the proposed ASU to be one that improves the accounting for PFAs, that's purchased financial assets, that do not fall under the current PCD scopes. Basically, what this is saying is that all loans, with the exception of credit cards, are going to fall under the PCD framework. So if we go back to this, basically what this means is that all loans, when this is finalized, it's going to look like the right side of this presentation instead of the left side of the presentation, where clients are going to avoid the significant provision expense and double count on day one. This is still being finalized. It's pending still, but it will be applied prospectively for annual reporting periods beginning after December 2026 and interim reporting periods within those annual reporting periods. Early adoption will be permitted for any annual or interim periods beginning in 2026. We see this as very positive movement from FASB. We've been waiting on it for a couple of years and are very thankful that literally just a month ago, it finally kind of moved forward and seems very likely to be finalized. So I'll launch our fifth polling question. So it looks like we're about 50-50. 50% think yes, and about 50-some% are undecided. And that really mirrors FASB's feedback when they came out with this. It's one of the reasons it's taken them so long is there was mixed feedback when this first came out. So not surprising that we're seeing some mixed feedback here as well. I'll give about 10 more seconds here. Looks like most have voted at this point. Okay, I'm going to end the poll. Okay, I know we're just about up here on time. I just have one last quick section here. I want to just really quickly touch base on credit unions buying banks. We already walked through this slide at the beginning of the presentation. Again, just notable that we have seen a significant increase in the number of these transactions. This slide, I'm not going to go through in detail because we feel that these deals can be relatively complex. And so we actually wrote a white paper. It was in 2019, so it's a little outdated, but most of the ideas still hold true. Just some of the metrics in the white paper are a little outdated. But we actually co-wrote it with another audit firm and a local law firm here in Minnesota, basically walking through all of the regulatory tax burdens of these deals, as well as kind of focusing on strategy. So I'm not going to really walk through anything on this slide, but if you are interested, this resource is out on our website. And then in terms of implications, I'm going to kind of skip by PCD and CECL because I think most of that's going to be kind of solved with the new pending guidance, where again, all loans will really be under the PCD framework, so we don't really need to worry about that as much. And we kind of touched on capital impact. Again, it's important for our credit union clients to understand, while a credit union to credit union merger can be accretive or dilutive to capital, a credit union buying a bank is always dilutive to both GAAP equity and regulatory capital, always. And so what we have seen is some credit unions have utilized subordinated debt as a way to finance these deals. It's been another, I would say, hot button topic in terms of kind of the credit union versus bank debate, but certainly something that we've seen in recent years. And one of the things I guess I kind of glossed over was we do tend to see higher premiums from credit unions when they're buying a bank for a variety of reasons, which is kind of walked through in this white paper. Typically, for a bank to sell to a credit union, they do need to have a higher premium, and there's a few other reasons as well. But what we have seen is some of these transactions have resulted in substantial amounts of goodwill. So just something to note there versus maybe some of the credit union to credit union mergers with lesser goodwill. Okay, so I have one last poll question, and I would open it up to any questions. Give another 10 seconds on the last poll question. Okay, looks like most have voted. Okay, any questions? And I guess the only other thing I'd mention is we did include our kind of services and main contacts, again, for kind of our various services. If you're interested in learning more about really any of these products, again, you have our contact information. I also included kind of a page to our resources. One thing we at Willery Win are really proud of is that all of our resources are available for free on our website. Nothing's gated. We don't track any information. Our white papers have literally been downloaded hundreds of thousands of times. So if you're interested in learning more about any of these topics, there's probably already a resource out there. And if there's not, let us know and we'll write one. But again, I want to open it up to any final questions. And I know we're up here on time as well. All right, it doesn't look like we have any questions. So again, wanted to thank everyone for joining today. Appreciate the opportunity. And Gabe, once again, wanted to thank you for allowing us the opportunity to present to your team. Thank you.
Yeah, thank you. Thank you for a great presentation. Thanks, everybody.